you can have the dollar trade weighted rising at a time of international credit and currency crisis and find that the gold price is rising at the same time. Because what's happening is that the whole fiat currency complex is going down. It is losing purchasing power. Whereas, of course, gold doesn't lose its purchasing power. It fluctuates a bit, but not very much.
You're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction.
Got it.
Time-wise. I think silver could be $300 to $500.
The global monetary landscape is witnessing a historic technical and fundamental breakout as gold decisively moves past long-standing resistance levels. This shift is characterized by a surge in momentum that traditional paper markets are struggling to contain, signaling a deep structural distrust in the debt-based financial system. As the U.S. national debt continues to expand, the paper tail of commodities exchanges is losing its historical ability to suppress prices in the face of relentless physical demand from global trade hubs. This transition represents a strategic move toward neutral reserve assets that carry zero counterparty risk, marking the beginning of an impulsive upside for precious metals as they decouple from decaying fiat currencies. Michael Oliver and Alasdair Macleod argue that we have moved past the fear and loathing phase of the market and are now entering a period of accelerating valuation. Their research highlights how the drain of physical bullion from Western vaults is a definitive signal that the 45-year debt supercycle is reaching its mathematical limit, necessitating a return to gold as the ultimate measurement of value. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Now look at the gold chart below. Go to the next page. Just simple, stupid price chart. Okay. Well, we're higher than that right now. In fact, if you factor in that we're rotating to June gold, then we're well above that last reading. But there's 3 months up there effectively stalled at the same price level. You get up to 53, 5,400. There was one spike above 55, but basically, at 3 months pounding the same level. Gold doesn't peak that way. If you go back to 2011, when you made your high in September, I think it was 2011, you dropped from 1900 down into like the 1500s. You never came back anywhere close to the 1920 price high. You came up into the 1700s again, but you couldn't get back up to the old high. Well, if you internally look at gold on a daily chart, anybody who's watching this right now, go to your quote screen, punch up a daily continuation of gold, you'll see that the peak daily close back in late January was just above 5,300. Early this month, we had a peak daily close just above 5,300. In other words, not only does monthly price chart go back up into that supposed thin air, but the daily price close went back up and effectively matched the peak close of January. In other words, the air is not as thin as you think up here. You shouldn't have been able to go back to the high again. We're saying now you go back to 5,300 gold again, they're going to blow your head off.
Yeah.
And for silver, we think the key level is getting back over 90 again. And we're talking price now, not momentum. Momentum will give you earlier signals. And those are in our reports. But for just a price chart guy, if you want to know when this, quote, correction is over with, which has really been a violent sideways consolidation if you look at it, you get back over 90 on silver and you get gold to 5,300, you better cover your shorts. Or you're going to wet them because they're going to blow at that point. And you're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction.
Got it.
Time-wise. I think silver could be $300 to $500.
That's a beautiful thing.
Yes, no. And the factors in play are both the monetary aspect, because if during that same time we see those S&P charts, one, have a little bounce now, waste some of late March, early April, maybe a couple weeks here, have a nice rally because the Iran thing abates or whatever. And then you roll back through those annual and quarterly structures we showed.
Mm-hmm.
You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds.
Yep.
Gold and silver.
Gold and silver.
Okay. You'll have a massive money flow out of that broken bubble into gold and silver once it becomes a public awareness that, oh my gosh, it's really broken.
Yep.
And the central bank will go berserk. And we already know, the new Fed chair is going to go berserk, which most people won't make a lot of sense of. Here's the daily silver chart since the high in January, the top chart. Forget the momentum. I've circled the 3 peaks up there just above 90. Those are the highs were rallied, each rally high after the break. Mm-hmm. They sold it over 90, sold it over 90, sold it over 90. Okay, it's a game. You go back there a 4th time, it's going to blow your head off.
Yep.
Meaning, hey, your ceiling isn't a ceiling. Okay.
Yep.
You shouldn't keep going back to the same ceiling. Okay.
Yep.
It states intent on the part of silver. So anyway, that's what I'd be looking at. And when you take that out, I expect to see the type of accelerated price move that we had coming up from November, December into January, with the argument that likely it'll be even more accelerated than what we saw then. You'll be fully realizing that, oh golly, I guess now it's $250 silver headed to 300 or 500. Maybe I should buy some. Well, you can if you want, but our average buy level was $36. So anyway, but yeah, no, and I think it will be a point where the market has cleansed itself nicely. Yeah. That's one good thing. Of late comers, right? People that got in early who had their helmets on and knew there was going to be a midpoint correction, which we said there would be. Yes, it was more serious than we thought in terms of percent, and a little bit sooner, like a month or so. But I still think was a midpoint, on the clock. And basically, we got another 3 or 4 months we could go. We get into the summer, and I think by then you're likely to see silver in a new reality, something it's long overdue for.
The gold market is currently navigating a definitive breakout as it decisively clears long-standing resistance levels that have historically capped price action. This shift in momentum signals that the paper tail of commodities exchanges is losing its ability to suppress physical reality in the face of relentless global demand. As the U.S. national debt continues its terminal expansion, the movement of physical bullion from Western vaults into neutral trade hubs represents a strategic exit from a decaying fiat system. This technical and fundamental realignment suggests that we have moved past the initial phase of market hesitation and are entering a period of accelerating valuation. The persistent drain of inventory on global exchanges confirms that the world is preparing for a multipolar monetary order, where gold serves as the ultimate measurement of value with zero counterparty risk. Securing physical positions outside of the traditional banking infrastructure is a necessary response to a debt supercycle reaching its mathematical limit. Let's get back to the interview.
The idea that the Turkish central bank has been selling gold is actually wrong. The whole of the gold scene in Turkey was a bit of a mystery. And some time ago, when I was in Istanbul at a conference, I spoke to some bankers about this, and I asked them to explain it to me. I can't remember the details too much, but I think very, very briefly, what happens is that the commercial banks have a lot of customers who own gold, and they store that gold with the banks. And that, if you like, works almost like an unallocated gold account, whatever. They take that gold and they deposit it in the central bank's vaults. The central bank returns that as if it was own gold. And it probably is, in the sense in that it is probably leased to the central bank for whatever reason against Turkish lira. So you've got swaps going on all the time. And so all you're seeing really is, and this is the difference between the way we account in the West. All you're seeing is the ebb and flow of gold between the commercial sector and the central bank. This is not gold which is going on to the international market because the Turks are trying to support the lira. I mean, I haven't seen them do anything really to support the lira. I mean, it's one of the worst currencies in the world. I mean, how do you explain a currency which goes down all the time, and yet they continue to accumulate gold, or appear to continue to accumulate gold, and then suddenly they turn around and want to support the currency by selling gold? Come on, this is nonsense, complete nonsense. So, I mean, I thought that's the first thing. Don't be confused by this. Now, what we do in the West is, if, let us say, a central bank leases gold into the market, it records it still as its own gold. It doesn't record the leasing, but somebody else will record the leased gold as their own property, which of course it is in law. If you lease gold, it becomes your property during the duration of the lease. So you get double counting. You could almost say that the Turks they do it a bit differently, probably slightly more honestly than we do, in fact. So all this stuff about selling gold in order to whatever, is actually nonsense. They will keep control over it. I mean, it's as simple as that. It hasn't come onto the international market. The dollar's trade weight has got nothing to do with gold. They're two completely separate markets. So you can have a situation where the gold price is going up or going down, completely irrespective of what's happening on the dollar's trade weighted. You can have the dollar trade weighted rising at a time of international credit and currency crisis and find that the gold price is rising at the same time. Because what's happening is that the whole fiat currency complex is going down. It is losing purchasing power, whereas, of course, gold doesn't lose its purchasing power. It fluctuates a bit, but not very much. And so the rate, if you like, of these currencies measured in gold appears to rise. Really, you should look at it the other way around. It's the currencies going down rather than gold going up. But the interesting thing is that on the shakeout has been a paper shakeout, not a physical shakeout, because retail demand, retail demand in the terms of, in Western markets has declined and probably sometimes have been net sellers, but in the Far East, demand has continued, and it's basically sucking bullion out from the West. That's continuing. And I think it's really, as I said earlier, there's this growing realization in investment banks and bullion banks and so on, that gold is going up. Quite why it's going up is something which perhaps they don't really understand, but nevertheless, they want to position themselves so they don't get caught. And I think it's as simple as that. And the best evidence of this is the massive decline in open interest in the futures markets. The speculators have been discouraged from playing, particularly silver. If you look at silver, the way it works quite simply is you just widen the spread. And, anyone trading on margins is going to think, well, to hell with that, or go to do something else. And that's really what's been happening. They've been trying to square their books. Remember also that a lot of these big American investment banks who have been calling gold higher, they manage huge amounts of money. They've got discretionary management powers over trillions of dollars, and their customers don't have any gold. They haven't bought gold for these customers. They might have bought a few gold mines as part of sort of portfolio mix, whatever, but they haven't got physical gold. So they need to get the gold down. They need to get into a situation where they can improve the position of those portfolios, particularly since those portfolios are very, very heavily angled towards industrial and tech stocks, and also financial stocks, which are basically beginning to underperform. So you can see there's a huge, great shift going on, if you like, in the entire investment management industry. They needed to get the gold price down because they didn't want to get caught. It's as simple as that.
The persistent drain of inventory on global exchanges confirms that the world is actively preparing for a multipolar monetary order. This environment of fiscal irresponsibility has forced a global flight toward assets that exist entirely outside the traditional banking infrastructure, as institutional trust continues to erode on a systemic scale. By recognizing that we have moved past the initial phase of market hesitation and into a period of accelerating valuation, one can navigate the final deleveraging of the debt supercycle with clarity. Securing physical positions now offers the only reliable insurance policy against a ledger system that has reached its mathematical limit. Share your thoughts in the comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing to more exclusive precious metals content. Thanks for watching.